Hello, everybody. I'm Michael Smith. Welcome to the Lowdown. Today, joining me, Kevin Lenox. Hey, Kevin, how you doing?
Good. It's been a while.
It's been a while. Yes, it has. Well, I tell you what, this year, if like anybody else, I don't know why, it seems it just is flown completely as fast, probably faster than probably any other year. Maybe it's because they were talking about, they're having Christmas decorations in August in Home Depot, which that should never happen. But if you have any theories on that, I'd love to hear them. But anyways, we've got 2026 coming up, and I thought today we could talk about kind of the bullish case for 2026. We'll talk about the bearish case. And one thing we are going to get to, I am going to talk about SpaceX IPO and how that could be either bullish or bearish for the market. So before we do that, Kevin, though, let's kick it off, and you kind of get us on the bullish case on what we could possibly see for 2026.
Sure. So I think the best way to characterize the economy this year has just been resilient.
Yeah,
we've had a few growth scares. We had the tariff issue in the spring, and now we're looking at GDP for the fourth quarter estimates from 2.5% to 3.5%.
Yeah,
which is well above trend growth. So at 3%, we'd call that a win. And so that sets a table for, it's pointing to underlying growth in the economy. So we've got a combination of monetary policy stimulus.
Of course, yep.
The Fed has cut 3 times this year, 3 out of 4 months. The 2-year Treasury at 3.5% implies another couple of rate cuts early next year, and that's
so more stimulus
baked in. And then we've got fiscal stimulus via the big beautiful bill, which actually peaks as far as stimulus in the second quarter.
Okay.
Which then, being mindful of the midterms coming up and about a 5-6 month delay between the impact of policy and the time it really feeds through the economy, perfect timing for the economy to be it.
So yeah, a lot of people don't know that. Definitely when you get stimulus or rate cuts, it takes 6 to 9 months typically for it to be shown up in the economy is what you're talking about.
Yeah, and then you put on top of that corporate earnings.
Yeah,
and the third quarter was a banger, 13.5% with 13% profit margin. So for all the concern about tariffs and weaker profits, we haven't seen it yet. Not in the S&P 500 companies. I think we'll finish the year for 2025 S&P earnings about 12%.
Okay, yeah.
And current read for next year is about 14.5%. So when you put together monetary stimulus and loose financial conditions, fiscal stimulus, good corporate earnings, it's hard to fight against the bullish case too hard.
Yeah, it is. It's a pretty nice trend. A lot of things going for each other.
And then you would add even M&A,
okay,
probably about a record this year. And one of Trump's policy pillars is less regulation, and with that then it encourages more M&A. And the figure I saw, record might take 2.5% of stock supply off of the market. So fewer shares, then it's easier for stocks to move higher. So at that level, things look fairly good.
Well, any other things to add to the bullish case? I mean, it's kind of hard to add too many things, but it seems like it's quite.
Stop there.
We could stop there. Okay. Well, I'll tell you what. Then so paint me now. That's going to be a hard picture to paint, but paint me a picture of what a bearish case might look like, and what your thoughts are there.
So going back to the rate cuts. So we've had 3 rate cuts in 4 months. What's interesting is that the 10-year Treasury yield hasn't moved.
Okay.
So it's just been the short end moving down, and inflationary pressures are still there. The PMI Flash Purchasing Manager Index flash report came out yesterday, and they talked about some of the sharpest increases in prices, output prices, since 22. And tariff and pass along price increases.
Have we seen all the pass along?
They happen in stages.
Okay, so we haven't seen all the pass along on that.
Probably so, yeah.
Okay.
Now, there have been a lot of carve-outs and exceptions regarding the tariffs that have diluted the impact versus what we initially thought. But if the Fed continues to cut rates and the 10-year doesn't move, then borrowing costs, particularly intermediate and longer term, are going to stay higher. And mortgage rates are most closely tied to the 10-year Treasury. So if those don't move, you're not going to get the help in the housing market. So this sticky level of inflation that is running about 3%.
Yeah.
Not far from the Fed target of 2%. And that's really hurting the lower 40% of households from an income and net worth standpoint. So hence that K-shaped economy. So we'll see how it plays out, but I think front and center is going to be rates next year and what happens to the 10-year as the monetary and fiscal stimulus really start to kick in.
Kevin, remind me, don't we have, like I'm talking about the United States, we have a massive amount of debt that's maturing next year, right? Don't you think a lot of that has to do with what we've been seeing with Trump? He's really been, pounding the table, trying to get rate cuts. Don't you think he foresees probably a way, or hopefully trying to get rates lower so they can roll that debt? Do you think there's some incentive there? And then of course, housing, I think for every consumer, that's our biggest barometer of if we're doing well or if we're not. For most of us, that's our biggest asset. So if our housing prices are up and all that is doing well, but at the same time, we know housing isn't moving right now. And so that could be a negative effect for the economy. What are your thoughts there?
I saw this week that the average home buyer, first-time home buyer, 40 years old.
Wow. And that should not be the case.
25 years ago, it was low 30s.
Yeah.
And so it just shows how unaffordable housing has become.
Well, and that affects the spending cycle of as you move through your first career, to your house, to forming a family, to all those things. This really delays that whole consumer cycle that we've seen.
People are getting married later.
Yeah, or not.
Having fewer children.
Or not having kids.
Yeah.
Yeah.
So it's, cultural changes as well.
Well, on the debt due next year, does the U.S. have a big amount of debt coming due? Is that going to be something that could be setting up for your bearish case?
So what's interesting is the Fed was always this independent agency.
Yeah, sure.
Now, they considered that.
Okay.
But now it was made public this year that Jay Powell, head of the Federal Reserve, and Scott Bessent, head of the U.S. Treasury Department, have breakfast together once a week. And they sort of coordinate policy.
They
and
might
Trump
talk about
has said that he's interviewing Kevin Hassett, the two Kevins, Kevin Hassett and Kevin Warsh. And he has said that he wants input on Fed rate decisions.
Yeah.
So guess what? Rates are going lower.
Yeah.
And then he floated the 50-year mortgage idea.
Which
has be a whole different show, but probably would not help.
No, it won't. No.
At the end of the day, would not help. But I think the rates will determine where we go, and front and center, I think, is what happens to the 10-year through all this. Well, the next big move in the market will be rate driven.
Yeah,
unless there's some geopolitical exogenous shock.
Very true. Well, so on rates too, even if Trump and Powell and team are able to get rates lower, you and I both know this. We've been in the game long enough to know you cannot manipulate rates low and they won't stay there. They can get there for a moment, but they're not going to stay there. The market's going to determine that. Maybe add your commentary on that.
And that's where the 10-year gets beyond.
Yeah.
The Fed controls the short end.
Yes.
So, and already we've had changes to the SLR, which is a whole different conversation. But rules were changed to encourage banks to buy and hold more treasuries. So there's a new source of demand for treasuries. And then you had Powell announce last week that as part of the reserve balance management, they would be buying $40 billion in T-bills per month for 5 months. So there's $200 billion in fresh demand. So they're monetizing the debt, clearly. Can't call it QE. They don't like that, but it's to manipulate rates. They want to massage rates below the rate of inflation.
Sure.
So,
do you think they'll be successful in doing that?
Eventually, I think there's a limit as to how long you can hold the balloon underwater.
Yeah. So there might be a brief opportunity for people to refinance, for the 40-year-old to get in the home.
But only if long end plays along.
Okay.
I've been, and a lot of analysts that I track have been surprised that, Powell's term ends on May 15th. Mm-hmm. Hassett or Wash are going to lower rates. That's going to be the bias. Yet we haven't seen long-term yields really move up. We keep hearing about this steeper yield curve, which means short end goes down relative to the 10-year or longer-term bond yields. It's steepened a bit, but the feeling was that it would have done a bit more by now, knowing what the policy is. So we'll see how that plays out.
So you're saying there's a chance?
You're telling me there's a chance. Someone will know where that came from. But then, the other issue we're looking at is AI.
Yes.
So that was all by the hyperscalers, which are Amazon, Google, Meta, Microsoft, the core companies investing the most in this new AI technology. They were funding all this CapEx.
Exactly.
Out of free cash flow.
How's that going to look?
So at the end of Q3 with the earnings report, then both Google and Meta came out with bond offerings that were a little bit of a surprise. Not huge, not necessary.
Yeah.
But it kind of points to that there's a limit as to how much these hyperscalers can fund out of free cash flow. 1.4, 1.7, maybe trillion.
It's massive.
For CapEx out of a necessity of they think maybe 3 trillion. So private credit is going to fill that gap.
Yep.
And we just had Blue Owl step away from Oracle's data center build out in Michigan.
So elaborate on why that would be the case.
So I think the multiples on these hyperscalers were tied to elevated multiples, tied to that they could fund this new technology, revolutionary technology, out of free cash flow.
Yeah.
Who else can do that? They were going to own the future of AI. And now when you start having to take on debt, and I guess with Oracle as the poster child, taking on too much debt, then you start to see, like, wait a minute, there's going to be an issue with that. And if this is going to have to be more debt-driven, then maybe we should assign a slightly lower multiple to these AI stocks.
Okay.
So we're going to have a separation of winners and losers. But I think I saw 30% of all the net credit issued this year has been AI related.
Wow. That's pretty substantial.
So, we're kind of at the point where CapEx, expected growth, is exceeding earnings from AI growth. So it's been the other way around.
It could be a lot more challenging this year to see the same group of stocks that are making the highs this year making the highs for next year. It's definitely going to be a new landscape.
It's going to be investors want to see earnings resulting from AI now.
Yeah.
We put so much into it now. There's so much commitment to it. I think it was last month, that 30 companies most concentrated in AI accounted for 42% of the market cap of the entire S&P 500.
Yeah.
So a lot matters for the market as how AI progresses.
Oh, absolutely. Well, I mean, we've definitely been through kind of this foundational phase, right? I mean, the infrastructure has been laid out. We now have multiple players. But now I think it's really going to be, kind of, the use case, right? I mean, which layers and which AI companies are going to basically be the most used across the board, and kind of looking at that adoption rate. That's really what I think this year. And usually in adoption rates, you see a lot of mergers and acquisitions or consolidation. What are your thoughts there?
Oh, I think that'll continue, yeah.
Yeah. Okay.
Large scale will pay off. I think that will be pursued going forward. So going back to private credit, the Oracle, then, that's the other potential blind spot in this economy. So private credit is exactly that. It's a privately arranged deal between borrower and lender, and there's a lot of opacity, and it's not regulated. The Fed doesn't really know. It hasn't been really recession tested. So we had Tricolor, which is a auto lender, suddenly go bankrupt off of fraud.
Okay.
And JP Morgan, who I consider the best risk manager on the street, got tagged for about $170 million loss on that. And like half of the people that lent through Tricolor didn't even have a driver's license.
Wow.
It's like when you hear about just stupid loans being made and lack of due diligence.
There it is.
Maybe
there it
I'll
is.
be more fair, lack of due diligence.
There it is, right there.
And just too much money coming in. They got to put it somewhere, so the due diligence, if we don't do this deal, somebody else will.
Well, that's kind of the recipe of every bubble. So much money coming in, you just got to put it where to go, where you can put it, right? And then they release the standards, because most of and correct me if I'm wrong, but most of these private credit companies, even if they're dealing with somebody that might be a possibility of bankrupt, they're going to go try to renegotiate those terms. They're going to get in there before they announce a bankruptcy. They've probably tried every single thing they can. So it's not just, we're going to file bankruptcy. There's a lot that had to happen. But at the end of the day, a good due diligence process should have probably seen that, correct?
And going back to Jamie Dimon, there was Tricolor, and then like right after that was First Brands. And Jamie Dimon came out with a comment about cockroaches. when there's one or two defaults,
Yeah.
think of it like cockroaches. There's usually more. It's not just two. Back to private credit and Oracle, so blew out. One of the big players in private credit stepped away from a financing deal for a data center. They're like one of the biggest financing companies for data centers. Stepped away from the deal in Michigan with Oracle. And there's a new wave. The data centers have been put in BFE, different places, but now they're starting to come back in. And now there's this NIMBY aspect, which is not in my backyard. So maybe space might be a good place for data centers.
Well, I did say I was going to talk about space. I did. So let's just kind of talk about that, because I think
the glasses are off.
The glasses are off, right? Yes, it's getting a little serious. I mean, SpaceX, you'd have to be completely out of the loop right now to not heard that potentially next year they're talking about SpaceX coming out with an IPO. It's the initial public offering. So they're talking about mid-year, and everybody's been talking about the valuation, about $1.5 trillion, right? It's going to be the largest IPO, the most anticipated IPO. Kevin, as a matter of fact, this morning I was trying to figure out what is equivalent, what other IPO in our career even comes close. And the answer is none. None. I mean, I was at pets.com. They were all boring, but they had huge valuations once they went IPO'd, but they're boring. They don't have the impact that you see that SpaceX has today, right? And so I look at this in a couple of ways. Number one, the bearish case, and I don't think many people are focusing on that. Let's just say that SpaceX, by the way, comes out in an IPO, okay? And if we've seen some of the other space IPOs, they come out of the gate roaring, doing pretty well. But if you looked at them, they've lost quite a bit. So we've seen the steam run out pretty quickly. Now, I am very positive in space. Most of you probably know. If you don't, you will. And but that is a possibility. And just the thought of that for a minute, and this is the bearish case, right? If SpaceX comes out, and even if it doesn't crash, if it just doesn't do much, I think that could be a bad negative aspect for the markets. I mean, what private company wants to go public if the most anticipated IPO that we've ever seen doesn't do well? So it could affect the markets quite well. Now, let's get to the positive side of things, okay? And so I think what I've been hearing is how much they want to raise, about $34 billion is what they're trying to raise. But I don't think anyone's really talking about why. And here's my theory on why, and I've read enough to kind of think that I might know that this might make some sense, is Elon is 54, okay? I'm not calling him old because I'm only 2 years younger, but he's very impatient. We've heard the stories. I mean, he likes to get things done when he wants it done, and quite frankly, he's pretty vocal about it. So I think he's seen, we've made a lot of inroads, by the way. We have made a lot of great things have happened. I mean, we're talking about space-based data centers is a big possibility out there. What we're basically doing is the equivalent of when the United States was all the population was on the East Coast and we wanted to go west. We wanted to go mine gold. What do? We build railroads, right? So those railroads, if you think of them, what we're trying to build in space right now, we have a lot of stuff in low Earth orbit. We get imagery and all these things, but we really have not built the communication system and the railroads. And if we've heard between Bezos now and Elon, the goal is to go to cislunar and to go to the moon, right? And then from the moon, obviously, Elon can, fulfill his dream of getting us let us be an interplanetary species to Mars. But I think he's getting tired of waiting. A lot of amazing things are happening. As a matter of fact, I think the greatest innovative cycle we've seen in our lifetime is happening now. I mean, you've got all these aerospace engineers, people that have been pent up, PhDs from NASA programs, only to see their projects get canceled over and over. They've started businesses and they've come up with ideas, and it's all been because of Elon, his vision, and basically launching rockets up there, and launch costs has come down. This affords all these innovations to come to fruition. So now what we've seen is we've got the space race 2.0. If you haven't heard, China's in the race as well. While we were 2 decades basically floundering away a space program, they were paying attention and they were trying to move ahead. They've got a 30-year plan, they got a 100-year plan. But back to the SpaceX, I think if it goes well, wow, it's going to usher some of the greatest capitalism innovation cycle we've ever seen. A lot of these space companies, I mean, we're going to move forward. And I think back to my comment earlier, he wants to push this faster because he knows right now the race is close. China's got 6 launch sites coming on next year. So this whole idea that, well, we're ahead of them in how many launches and how much cadence we have, well, that cadence could be turned over. He knows this. Elon knows this. So if we're going to get to the moon, if we're going to get to some of these other technologies and the space-based data centers, that gives us an opportunity to expand AI and actually do something we're not really doing much of, is producing money in space, right? And then making some real breakthroughs. So I think he's trying to push this. And then, of course, the drag is always policy. You got 3 different associations that decide when you actually get the launch, where you can launch to, and when that comes back, and they don't speak to each other very well. So that's really the big drag. But I think him pushing forward, getting this big usher of this huge CapEx spend and pushing the technologies even further, that's going to pull policy to where we need it, or at least I hope. So that's kind of my bullish case. And let's just pray to God that that is the case, because we don't want to see the other one. Yeah. Any thoughts on that?
It'll be interesting. Now, I get my information from you.
Okay.
You go to conferences, you're plugged in really well to that area. So, yeah, I'm looking forward to see how it evolves and your perspective on how we can monetize that.
Well, I'm looking forward to it. I think it's going to be exciting. So hopefully it's not the latter as we talked about. But Kevin, any other parting thoughts for anybody as we go into 2026?
So I think given the policy, the read through is that, in a traditional 60-40 type of a format, and we've talked about it before, the headwinds for bonds are probably going to be more intense than they've been in the last couple of years.
Okay.
So probably more of a tactical overweight within the bond space, more to tips maybe.
Okay.
And then probably I think EM looks attractive, emerging markets.
Emerging markets, okay.
Look attractive because the policy supports a weaker dollar.
Yeah, for sure.
And that helps international investments. So,
okay.
And then, and the EM gives you a bit of a commodity type of exposure, but when you've got full fiscal, like, countries around the world, that tends to drive growth, tends to be favorable for commodities overall.
Awesome.
There's different ways to play that, but that type of exposure.
Yeah. Well, great. Well, look, thanks for joining me, and it's going to be it's been a fun, interesting 2025. I think 2026 is going to be even more interesting. So we'll see. All right, Kevin, thanks for coming.
Sounds good.
Thank you.